8 Dividend Aristocrats to buy now for a lifetime of passive income. Dividend stocks are a great way to protect against a downturn, and these are the cream of the crop. There is no one-size-fits-all strategy that has the potential to make investors wealthy over time. But there are few approaches that have a better track record of success than investing in dividend stocks. Companies that pay dividends are often successful, profitable businesses year in, year out, which have generally proven over time that they can withstand market cycles and recessions. They also have a bright line history of outperforming their peers that don't pay a dividend. 8. ABBV. ABBV, ABBV, is not your typical dividend aristocrat because Standard & Poor's allows spin-offs to absorb the dividend history of their former parent company. Since the pharmaceutical stock was spun off from Abbott Laboratories, another dividend aristocrat, in 2013, ABBV enjoys the double dipping afforded by the rules and is credited with some 50 years of dividend payments. While the drug developer has been paying dividends independently for only a relatively short time, ABBV has rewarded shareholders by increasing the payout every year so that it has hiked its value from the original quarterly dividend of 40 cents per share to its current level of $1.48 per share, a near fourfold increase in 9 years. The dividend yields 3.7% annually. 7. Amcor. Born of a merger with US-based Bemis in 2019, UK-based Amcor, AMCR, makes flexible packaging for food, beverage, pharmaceuticals, and personal care products. Amcor recently lowered its guidance for its fiscal year due to the US dollar's strength, but it expects to produce between $1 billion and $1.1 billion in free cash flow. The packaging specialist's dividend of 49 cents per share currently yields 4.1% annually, which should provide investors with plenty of income to offset any short-term impact on the stock price. 6. Consolidated Edison. Regulated electric utility Consolidated Edison, also known as Con Ed, has increased its dividend for 48 consecutive years, the longest streak for any utility in the S&P 500 index. It means it is poised to become a dividend king in short order, or a stock that has raised its payout for 50 or more years. S&P 500 membership not required. The electric, gas, and steam delivery utility recently announced it would be selling its clean energy business and using the proceeds to pay down debt. Its annual dividend of $3.16 per share yields 3.3%. 5. Chevron. One of the biggest and best-run oil and gas giants, Chevron, CVX -0.29%, is reporting record earnings on elevated pricing, limited supply, and continuing global uncertainty about Russia's invasion of Ukraine and the resulting sanctions that were imposed on Russian oil. Despite this, Chevron stock remains cheap. It trades at 10 times trailing earnings and next year's estimates, a fraction of its projected earnings growth rate, and just 14 times the free cash flow it produces. In addition to a cheap stock, Chevron's dividend yields 3.1% today, and the company has bought back $7.5 billion worth of stock so far this year. 4. McDonald's. McDonald's, MCD, is the largest restaurant chain in the world, and it's still growing as the fast food giant continues to resonate with consumers. It is seeing greater store traffic in all the regions in which it operates while also enjoying double-digit same-store sales growth. 3. Stanley Black & Decker. Toolmaker Stanley Black & Decker, SWK, has been getting hammered as the housing market slowed and then began to fall. But that is also forcing the company to get leaner and focus more intently on its core business in a bid to align with current conditions. Stanley trades at less than 18 times next year's earnings estimates and just a fraction of its sales, while paying a dividend as it has every year for the past 146 years. And it's increased the payout for 55 straight years. The dividend currently yields an attractive 3.9% annually. 2. Cisco. Food service distributor Cisco, SYY, could be affected by a recession as it would impact how many people are eating away from home, whether that's at a restaurant, a hospital, a school, or a hotel. Inflation and high gas costs would also impact its truck-heavy delivery business. Its stock had been down 20% year-to-date just 2 months ago, but has marched back strongly as expected, and now Cisco is riding 10% above where it started the year. Even so, it goes for 18 times earnings estimates and a fraction of its sales, which when coupled with its history of dividend payments makes it a good long-term buy. 1. Walmart. Walmart, WMT, will come into its own once again if a recession does hit. It's already seeing robust growth, particularly in groceries, as consumers seek out its everyday low prices to make their budgets go further. The retailer is even seeing customers with household incomes north of $100,000 shopping its stores, showing how much its value proposition appeals to consumers of all economic backgrounds. For now, though, they'll be sticking with the store that gives them across-the-board good value, and that means, especially in a recession, Walmart will be a leader. With a dividend yielding 1.5% that it's paid and increased for almost 50 years, this discount king should soon be a dividend king as well.